What is going on, guys? Nick here, back with another video. So today I thought I'd make a little bit of a different video, and I thought I'd talk to you guys a little bit about my strategy for investing for the rest of 2022. So I think over the past year or two that I've gotten a little too spread out with some of the companies that I've owned, and I think that what I need to do is to consolidate a little bit more. So I do heavily believe in the idea that to build wealth, you need to concentrate, and to protect wealth, that you need to diversify. And I think that what I've been doing is I've been getting a little too diverse with all the companies that I've owned. So taking a look at my portfolio for the last year, you can see that it's not been really a great year. So I'm down about 13% over the past year. I think the first thing that sticks out when you take a look at my portfolio is how I kind of blew it up in July when I dropped about $12,000. I lost that all doing credit spreads for options. Basically, I was betting on Nvidia having a pretty sharp rise all the way up until their stock split, and then I figured that the stock would end up falling by a lot. That didn't exactly happen. And because of that, I dropped about $12,000. And then for about the rest of the year, I pretty much sat flat. I didn't really gain or lose too much. And then you can see that during this recent market dip that, I've dropped a lot, and then I've come back up, and then I've dropped a whole lot again, and now we're starting to come back up. So I think the reason why you're seeing this big drop right here versus kind of the long-term growth of my portfolio, which has been pretty steady since I started this account, although right here I only had like $100 in the account, and this is where I actually started to move a whole bunch of money over. I've been pretty steady with my returns for the most part. Now, obviously you see the last year hasn't really been great, especially compared to, the rest of how this looks. But I think that there's a pretty good reason for this, and I'm not really terribly concerned about it. The reason basically is I've just gotten a lot more leveraged over the past year, and because of that, there's a lot more volatility in my account. The big ones are actually here where I bought some leaps. You guys know that I've been big on Visa over the past couple of months, that the stock sold off way too far, and that as international travel comes back, I think the stock's going to come back. So what I've done is I bought some leaps. So initially I had a leap at $170 strike price. It doesn't expire until January of 2023, and if we just click on this, we can see how it's doing. So you guys can see that I bought this at the end of November, an average cost of $4,110, and it's currently up about 35% since I bought it. So that's pretty good. But the problem though is if you look over at the past couple of months, so I'll put it on the 3-month chart, you can see that I was at about 7,000, and then it dipped all the way down to only 35, so I was taking a loss right here, and now it's come back up a pretty good amount. But because of this volatility, this is a massive swing in my account where it's gone up to $7,000 all the way down to $3,500, so dropping about $3,500 over just a couple of months really. And then the other thing that I did, so I actually had 2 leaps on Visa. During this most recent sell-off though, I noticed a really good opportunity. So for me, Apple has been one of my longest holdings. You can see going all the way back to September 6th of 2016, I bought 1 share of Apple for $107.59, and keep in mind that Apple's done a 4-to-1 stock split recently, so this is about $25 to $30 and 4 shares that I actually bought that day. And this stock has done incredible for me since I bought it. But recently the stock did drop off of all-time highs, which were around 182. It had dropped to 150 a share. And I thought that this is just an incredible deal that I have to get on this somehow. So what I decided to do was to take one of my Visa leaps that I had and actually transfer it over to Apple. So I picked up this call on Apple at $140 strike that doesn't expire until June 2023. Let's take a look and see what the cost was for it. It was essentially the same cost that I got the Visa leap for, so I didn't really lose anything. It was just kind of like a trade. Yeah, so my average cost was $3,500 on this. It's up about $1,000 right now, so 32%, so very, very good. I got it on the 24th of February, so really not too long ago. So you can see that I would have bought it right about here, so not terrible with the timing. I could have gotten it probably a little bit better. Looks like I could have got it for about $500 less than what I actually paid, but pretty happy with this run. Obviously though, I don't necessarily care about this recent run. I really care more about the long term. I'm not really looking to trade this as an option, but one of the big advantages though to purchasing these leaps is the second part of my strategy for 2022. And that's basically to use the theta gang strategies of selling theta on options, which is basically when you look at options that are priced out of the money, you'll see that as the option gets closer to the expiration date of the contract, those out of the money options start decaying in value. And the sharpest decay in value is between the 45 to 21 day mark. So the main idea of selling theta is basically trying to sell a contract that's out of the money, in this case calls, and then once the option gets to about 21 days before the expiration of the contract, I just roll it back out to another 45-day contract. So we can see right now that I sold a call on Apple at a $185 strike. Currently, that contract is worth $236, so I'm going to show you guys a little bit of how this works. So I sold it on the 24th, not too long ago, and I am down on it right now. I'm down about 35 bucks. I sold it for $201 when I sold it. So now there's kind of three scenarios that I kind of play out here. So the first scenario is if I decide to take kind of a stop loss on it. So the way I've decided I'm going to do this is if the delta of the option gets over 30, that's when I'm going to roll it. So we can take a look at this one right now. Right now it's at 26. It was closer to 28 yesterday, so that's a little bit better. But if it were to hit the 30 delta, I would roll it at that point. And if I click on this, I'll show you guys kind of how I would do that. Okay, so here's my option right here that I own, the $185 strike expiring on May 6th. So what I would do is I would just go out to the next week that I can put. So this is going to be May 20th. And then it would probably just go up by the next strike that I have above. Here I'd probably have to take a loss, dropping to 200. That would be about a $35 loss from the current strike price. So you can see if I were to roll it, the total debt right here would be $36. So I'd lose about $36 on that. But eventually the rally is going to slow down at some point. I don't necessarily know when exactly that will be. And I would cash in on this covered call. I'm going to be very aggressive on rolling these early so I don't get assigned on these. The other two ways that I end up rolling this is either it gets to the 21 day mark and I just roll it back out to 45 days until expiration. And then the next strategy is if it gets somewhere between like a 50 to a 20 delta, at that point I'm probably going to roll depending on how far through the cycle that I am. So basically the way that this works is I have a Apple call, I have a Ford call that I'm selling. I'm also selling a credit spread on SPY puts. I'm doing the same thing with Visa, selling another credit spread put. And then I have this kind of weird CVS call. So the reason why I say it's weird is a couple years ago, I made a video about 4 stocks that I think you should buy now. It's like one of my first videos. And I realized that CVS was massively underpriced. So what I decided to do at the time is I picked up a call for dirt cheap that was way below what I think the stock should be worth by the end of the year. But right now it's at $880. So it's basically a stock that I expected it would rise by a lot. And if I was right, I was going to have a good payoff. And that's exactly what happened here. So what I'm going to do though is I'm going to use all of that cash generated by these calls, one as protection, just in case one of the stocks shoots up a whole bunch. I have to have some cash on reserve to be able to cover those calls. The other thing is it allows me to automatically reinvest some of that profit back into stocks that I already own and already like. So if we go down to the stocks that I actually own, you can see that I own about 16 shares of Apple, about a third of a share of Visa. I actually really just have this so that I can see the share price a little bit quicker. I have some Amazon that I'm starting to rebuild back into. I have 2 shares of Google. I've owned these for a long time, bought them for about $900. Facebook I've owned for a long time also. Still, I'm a long believer in that, even if the stock price has cratered recently. I think the sell-off was not really a reasonable reaction to the earnings report that had come out. I've owned 13 shares of SPY for a pretty long time, and I'm starting to build in some Berkshire Hathaway A shares. Why A? Because it's more fun to say you're a Class A shareholder, and stock splits and the stock price don't actually matter. The stock, if it's going to rise, it's going to rise just as much for Class B versus Class A. I got about 25 shares of CVS, 114 of Ford. So if you notice, I do have 2 covered calls that I'm selling on Ford. One is through a leap that I have with a strike of about 12. And then the other one is off of these 100 shares that I own. I own 20 shares of Penn. I used to own a lot more. The reason why I initially had gotten so many shares was because the stock had just sold off way too far. And I think I believe in the growth of the other companies a little bit more than Penn right now. So that's why I kind of spread the money out to those. I still own my Hood shares. I feel bad about telling people to buy that one. So I'm taking the L with you guys. I have a little bit of Tyson's. I've been building into Microsoft. I need to kind of get rid of this one. I don't know why I have this still. I still have some Coinbase. Just kind of, it's not very much money and it's only, a share, so not really too much. Some Snap, some Intel, a little bit of Zynga. I actually got these for free, entirely off of just selling puts and then using the cash that I got from the sale to buy the stock. So I ended up with about 3 shares of that. I only did that for a couple months, really, just to try it out. The rest of these are just kind of like playing around with these positions. But the other thing that I'm doing is I'm doing reoccurring investments. So every single day I put $2 into all of these companies, and that adds up with all of them over the week of investing about $100 a week. And I think it's a really smart way to build positions over time. That way, I just feel like I'm very bad at trying to time the market, and this way I don't really have to worry about that. So that's kind of my strategy and my portfolio for 2022. Now before you go, YouTube says that you guys should definitely check out this video I have right here for you next, and as always, thanks for watching.